Hello and welcome back to the statement of profit and loss. In the previous video, we did learn about the income, what is the direct income, what is the indirect income, and why we should be separating the two. In a nutshell, we should be separating direct income and indirect income is because the direct income is coming out of business operations and is important to know is separately for the consistency of comparability, while the indirect income is coming from the activities which are incidental to the business, still related to the business. For example, interest on bonds or interest on short-term investments which you are making out of the surplus cash, or a profit or loss on the sale of disposal of fixed assets, which is in the ordinary items. It does not include the sale of business itself or sale of a major part of assets, which is extraordinary. It's not a normal business usual activity. um, in this video we will be learning about the expenses. Now expenses, the heads of expenses depends on type of company, type of services, type of industry. So here again we will not be going into the details of the line by line expenses. What we will be covering is the concept. Now expenses also same as in income can be direct and indirect, and usually direct expenses we split into two heads again, cost of sales and payroll. So cost of sales here you can see is divided into cost of material consumed, because this is a trading company. They produce the petrochemical products and they sell it. So they have in this company we have cost of material, then they have stock in trade, and changes in the inventory and then excise duty, so that the total of all becomes cost of sales. They have separate out the employee benefit expenses. So here is says what are the cost of the employees. Now this one is different head. Why? Because most of the time payroll expenses are fixed. They did really a lot of it, not 100%, but majority part of it is fixed, and it doesn't depend on how much revenue you are earning, because you hire employee, even if you are not producing, not selling anything, you still have to pay the salaries. Cost of sale is in direct relation to the revenue, direct income, because this is cost of doing the sales, this sales. So that's why we need to know direct expenses into separate. Now there are indirect expenses as well, which are like finance cost, your other expenses. Other expenses we'll be looking in more details, but primarily it's considered of selling expenses, your administrative expenses, your maintenance expenses, and all those kind of expenses. There are other type of expenses, as you can see here: finance cost, depreciation, taxes, which we'll be also be looking at in details, and those are also usually separate out to calculate the operating profits, operating efficiency ratios, and other kind of things. Let's look at the other expenses in a bit detail in the schedules. So let's look at the schedule number 28, which was for cost of sales. In this, 11 here. So we have other income, which we learned earlier. Now we have changes in the finished goods. So here how they are showing it, what was the inventory in the beginning and what was at the commencement, and then how much was consumption. So this is changes in the industry, changes in the inventory, and they have whatever they purchase, whatever this company purchase, it's going into the P&L as a direct purchases. So that's why they get cost of sales in a nutshell. Employee benefits and expenses here is, they say they are divided into salary and wages and contribution to the provident fund. In some countries there may not be a provident fund, there may be other funds, or maybe there is no regulation from the government, but there are some social security benefits. So all those costs are here and they are recorded separately. Now this company is recording staff employee benefits in accordance with the Indian accounting standards. So accounting standards require them to disclose more details about the benefits, provident fund and other things. So how this is defined contribution, we will not go into the too much of details of define what is defined contribution, what is non-defined contribution, and how these reconciliations and accruals are made, because that's out of the scope from this course. Now but what we'll be looking at is the other expenses here. So the finance cost is just only interest costs on a lot of loans that you have been taking. So those are and here you can see a sum line. Interest are net of interest capitalized 3,302. Now what does it mean? It means that sometimes you take loan to do a lot of projects, right? So all of the interest that you paid, that you are paying, is not supposed to be charged to expenses. A lot of that should go can be gone into the cost of fixed assets, depending on the eligibility and criterias, if they are fulfilled. For example, if you have taken a loan to develop a fixed asset or project which is going to take like 2 years to develop, so if you have taken a loan to that, until the completion of the asset, you can add the cost of the interest that you are paying on that loan to the cost of asset. So that is the meaning of interest capitalized. The rest of the income, interest which you are taking to operate the business or as a working capital, that is normally charged to the profit and loss. Here is another big gray area where companies might play. They, if to increase a lot of profit, they can increase the charge of the expenses instead of capitalizing, or if they want to increase the revenue, they can capitalize all of the interest into the P&L. Now usually auditors are supposed to qualify that, but in real world sometimes it doesn't happen. Other expenses are manufacturing expenses. What are your electric, fuel, repairs, and selling and distribution, and then your administrative expenses. So these are the establishment. So these are administrative expenses. So this is now usually a norm in the various industries to classify into 3 categories. Your cost of your manufacturing or production or maintenance, and then there are the selling, distribution, and then there are establishment. So establishment is most of your administrative expenses, professional fees, rent, insurance, and other things. And then you have selling and distribution, where you're gonna be putting up your marketing expenses, your warehouse distribution expenses, and manufacturing expenses, maintenance of the plant and other consumables which you are using, including the electricity and power. So all of the whichever account heads you have in your entities, those need to be reclassified into the manufacturing expenses or selling expenses or establishment expenses. Now there are other expenses which are like depreciation. So we go back to the main P&L here. So in this so we learned about the employee benefit, we learned about finance cost, we learned about other expenses. Depreciation we learned in the first video, where we looked at the fixed assets in the balance sheet. Depreciation is nothing, just only a reserve, or you can say a provision created to replace the assets in the due course of time, so that you can and it's also a matching concept, because the value of assets deteriorate over a period of time. So the cost of that asset need to be matched with the revenues which you are generating. So the depreciation method is usually based on can be based on how much income you can generate out of the asset. If you can easily know about it, if those are not direct or those can be not known, usually you have 2 methods, which are straight line method, means you just divide the cost of asset into over its life. So just as we saw earlier for the lease assets, And then there is another method which is most prevalent at this point of time, which is written down value. So what we do is we have a certain percentage over a period of time, around 20 years or 30 years, that asset will be written down to the minimum value, but it will continue to calculate a depreciation a longer period of time, because you still have a value. So usually those rates are defined by the tax rates, or defined by the regulatories. You can follow those rates. So there is no specific rate defined by the accounting standards. So those are all management estimations and judgments that also give rise to creative accounting. If you want to increase your profits, you just reduce the depreciation rate. So initially you gonna be paying more, you're gonna be having more income, but then remember you have to pay higher taxes as well. Not necessarily, because sometimes the tax has a very specific rates, so the tax will calculate based on their rate, but accounting depreciation is different. So that is another difference which will give rise to the deferred tax in tax expenses. So if your tax income, if your book profit under the book is lower, is higher than what you are supposed to pay to the tax, then you have to recognize as a deferred tax, because that if it's because of the timing difference, means you have to pay in future, but you are just getting some advantage now. Maybe because of depreciation you are charging a low rate of depreciation in your books, but tax department is charging higher tax rate, depreciation rate, which means you are having an advantage at this point of time by paying less taxes while compared to the book. So in this particular case, the company was supposed to pay 11,000 on 45,000 income, but they actually paid only 8,000. So the 3,000 will be paid in future to the tax department. So that's how the requirement to calculate the tax is coming out, 11,000. So there is a profit of 33,000. The next item in the line is other comprehensive income. Those are mostly the income which are income or expenses which are unrealized. For example, unrealized foreign exchange gain, unrealized income which is not yet due, or sorry, is due but is not yet realized, or just a market value differentiation, or other adjustments which are not related to the operational, are mostly related to the ownership of the minority interest, or to the owner's interest. So we will not go into too details, because that's not really very important in analyzing the profit and loss, because mostly you will be should be focusing on the profits or earnings before interest, tax and depreciation. Here usually in the profit and loss you are calculating a term called earnings before depreciation and taxes. In this P&L, which is they are not created separately. Now the earning before depreciation and tax is nothing but earnings before interest, depreciation, taxes and amortization. So why we know that? Because this is a better measurement of operating income, operating profit, because depreciation depends on judgments, taxes depends on the tax rates, and interest also, it depends on the leverage of the how much is the capital leverage ratio of the entity. But it has nothing to do with the operations or operating income or operating efficiency. So that's why we add back those things to earn to compare the percentage or compare the profitability of the entities with other entities. Okay, and then we learn about other comprehensive income. Now analysis in terms of percentage and trends, we will be looking at in the next video on this, and then the control aspects we'll also be looking at the next video. So keep watching. Thank you.